All right. All right, so topic 6 and topic 7 are talking about risk management and managing exposures to foreign currencies, right? So if you're outsourcing your production to China or Indonesia or wherever, you're exposed to an appreciation of the currency and it costs you more to produce the good. And to the extent that you sell to other areas like the Eurozone or South America, you're exposed to a devaluation of the revenues, right? You're getting euro revenues, you're exposed to a devaluation of the euro, you'll have less dollars coming back. So these next two topics deal with that exposure to currency specifically. And we're going to talk about the first lecture here. It's the identification, measurement, and mitigation of translation and transaction exposure. So I first need to explain what are the different exposures to foreign exchange. Talk about translation, transaction, and in this lecture talk about how to hedge them at a high level. The next lecture is very specific. How do I buy that put option or call option or forward contract to hedge it, and what does that do to my cash flows? Okay, so this lecture is all trying to figure out what something like this even means, right? So this was September 10th. All right, so it looks like an earnings miss by GM, cost and unfavorable foreign exchange impact of the Argentine peso. All right, so what does it mean that they missed earnings due to a devaluation of the peso? All right, so we need to figure that out. So this lecture is about what does this mean? I don't know if you guys have, any of your companies have kind of released statements, and earnings releases and talked about, effects of foreign exchange. All right, so if you have, that's what this lecture is about. Like, what are they talking about when they, and there's probably words you've heard in those meetings, translation, transaction, and it kind of went over your head. So I want to talk about what those mean. When your company misses earnings due to a foreign exchange, and you didn't get your bonus, what exactly went on, all right? So we're going to talk about types of foreign exchange exposure, translation. That's the translation and transaction. That's what this lecture is about. I'm going to have one more lecture on this topic next week, and that's competitive exposure, all right? We're going to talk about translation methods, a little bit of accounting, talk about managing these exposures, all right? And also talk about this general approach of identification, measurement, and mitigation. How do we think about managing these risks? Yeah.
Are you recording?
I am recording, I believe. Yeah. What's that? Where'd that little thing go? Hold on. I'm going to make sure. All right. It's recording, including the break to determine whether or not we're recording. All right. All that. I'm not going to edit that. All right. So I'm going to relaunch. But thanks. It's good to make sure it is recording. All right. So the first thing is when we talk about foreign exchange exposure, there's really three different flavors or types of these exposures. We're going to handle the first two in this lecture, the third one next week. So the two big splits you need to understand is translation versus transaction. All right, translation exposure are potential losses from an adverse change in an exchange rate. All right. However, these losses are strictly confined to the balance sheet. In other words, they don't actually hit net income or earnings or cause you to miss your earnings number. All right. So we like to think of these as like paper gains and losses. They're not real yet. It's just the accountants are showing a loss. Now they could be real. So an example of a translation exposure is a firm must reduce the value of euro-denominated accounts because the euro devalues. Say you had accounts receivable in euro, and the euro devalues. Right, those accounts receivable on your financial statement are in dollars, right? Right, everything's in dollars, obviously. So if you have a invoice that's in euro and the euro devalues, you may have to restate the value in the balance sheet. That's what I'm talking about.
Professor,
yes.
Is that like in the case from AES, they said that they had to write off 3.5 billion. Is that the same reason?
I have to read the case again. I don't know if they're specifically said translation or transaction.
Okay.
Okay. So translation is it may or may not be real yet, meaning it may not actually hit your bottom line, your pocket yet. It's just that we have assets, say an invoice to a customer out there that's denominated in euros, and the euro devalues, so I'm probably going to get less, so I better report that there's a problem. I'm going to write down that accounts receivable. That's translation. Transaction is actually when it hits cash flow, earnings. And it's a very subtle difference. So, for example, if you had a payable in, say, RMB, Chinese RMB, and at the time that you had to pay it off,
they said transaction loss of 456 million.
All right, so it is a transaction. Okay, so that is an actual loss. Thank you for reading that. So AES case was a transaction loss. So what transaction losses are there actual cash flow losses that actually go down to the income statement and cause you to have impacts on earnings, not just your balance sheet, your income statement. And again, the example could be you have an RMB accounts payable, and just when you go to pay it, the RMB appreciates and it costs you more dollars to pay it off. Or you have a euro receivable, the customer goes to pay you the euros, and just when you go to convert those into dollars, the euro devalues and you get less dollars. Those are transaction gains and losses. So it's either paying more foreign currency because that foreign currency appreciated, or it's receiving less foreign currency because it's depreciated. All right. Now, where it gets really confusing is translation exposures may eventually lead to transaction exposures. So, for example, you have accounts receivable in euro, but the customer doesn't pay you for 9 months. And then every month, the exchange rate's going up and down. And you'll show a translation gain, then a loss, and a gain or a loss. It doesn't really matter till the day they pay it and you convert it back into dollars. That's when it determines whether or not it's a transaction loss. So as your company's releasing information about gains and losses, be careful. Look for the word translation or transaction. Translation means it's not real yet, and if the exchange rate bounces back, you might get better. Transaction means it's over. You lost the money.
So is this something, and this is not the right word to use, but that you can hedge with either late fees or interest fees?
Yeah, so the end of this lecture and the whole next lecture is about hedging these exposures. Okay? Now, competitive exposure is basically very long-term transaction exposure. And that's what we're going to cover next week. So here's the problem. You may have, say Google and Microsoft and IBM, they're going to be making money, or earning euros for decades, right? However, there's only receivables out there for maybe 6 months or 9 months, right? Actual contracts to receive euros. However, if the euro devalues, say 20, 30%, and stays there for 10 years, nowhere in the accounting system are they picking up this huge loss they're going to have for 10 years because they're getting devalued euros, because there's no contract on it. So competitive exposure is really your long-term exposure, past just the receivables and payables you have right now, your long-term exposure to a change in a currency. And that's what we'll deal with next time. Okay? So you got translation, balance sheet, paper gains and losses. Transaction, cash flow, income statement gains or losses. All right. You okay? Questions? All right. One thing we're going to do for the next couple lectures is we're always going to do something called exposure netting. In other words, if you're a multinational company, your U.S.-based multinational company has 100 million receivables in euros and 70 million payables in euros. We'll take 100 minus 70, and we'll say the net exposure. Say both these receivables and payables have, say, a 3-month maturity. All right. What we're not going to do is we're not going to hedge every transaction, and we're not going to talk about the exposure of every transaction. We're going to net them and say 3 months from now we're a net receiver of 30 million euros, and that's how we'll talk about our exposure. And what we'll say is we're a net receiver of 30 million euros, or we'll say we have a net asset of 30 million euros. However, if you're really cool in finance, you just say we're long 30 million euros. So that's just a finance word of just saying that's our net exposure. And when we say the word long in finance, what that means is you benefit from a price increase and you lose from a price decrease. So when I say I'm long 30 million euros, that means if the euro devalues, I lose. All right? And it makes sense, right? I'm going to receive 30 million euros next quarter, say. And if the euro devalues, that means I'll get less dollars when I trade them back into dollars. On the other hand, if you had 50 million receivables and 70 million payables, you're a net payer of euros. So you actually benefit if the euro devalues. It'll cost you less dollar to buy the euros to pay off the payable. So the first step in trying to figure out what your exposure is to a currency is net all the transactions by currency and figure out if you're a net receiver or a net payer. In other words, are you long or are you short the currency, and by how much? Yeah.
So this is assuming that you know, this is a total accounts receivable, accounts payable. It's what you're actually going to get paid at this point. So it becomes transactional or
yeah. So I'm gonna yes, you're exactly right. I'm gonna have to make a split at some point between translation and transaction. Transaction is gonna be focused on dates, like what's your payment per quarter or something like that. Translation is all the accounts. So yes, you're right. I'm gonna talk about that over the next 20 minutes, if that's okay. Yeah, but yeah, you can see what the problem is. Do I add them all up, or do I just look at like December's payables?
assuming you're going to get paid.
Right.
Just 'cause they're paying.
Well, yeah, you got to make a guess when you're going to get paid. Yeah, otherwise it might slip into next quarter or come early. Yeah. All right. So you're either a payer or receivable of currencies, and then the next thing is, well, what is my exposure? The problem with is how do we decide? Say we're a net receiver of 30 million euros. We're long 30 million euros, and let's focus on translation gain or loss. All right. If we're going to focus on that, we need to figure out, well, what are the rules that determine when I have to revalue those accounts? Like, can I just let them sit out there at whatever the exchange rate was when I booked it, or do I have to change it like every month? And if I change it, do I have to just leave it in the balance sheet or income statement? All right. So what we're talking about now is translation methods, accounting translation methods. What is the accounting rule that tells us when we have to recognize the gain or loss due to a currency change, and where does it go, the geography of it? When I say geography, it's balance sheet or income statement, not North America. So, it's the geography of the gain or loss. Is it in the balance sheet or is it an income statement? So here's an example. This is Zapata Auto Parts. Say this is a Mexican affiliate of an American US-based multinational. And here is their Mexican peso balance sheet. The sub of the American firm. They have cash of 1,000 pesos, forget about the millions. Receivables of 50,000 pesos. They got auto parts inventory of 32,000 pesos. They have net fixed assets. We'll call that property, plant, and equipment of 111,000 pesos. So they have total assets of 194,000 pesos. They have accounts payable and debt denominated in pesos. That's total liabilities of 59,000 pesos. Equity of 135. 135 plus 59 is their liabilities and equity. All right, so this is the very simplified incomes or balance sheet of Zapata Auto Parts, the Mexican affiliate of an American firm. All right. So, say the exchange rate as of the date of this report, the exchange rate is 12 pesos per dollar. Okay? That's the exchange rate at the beginning of this period. What we're going to do is talk about what happens when this exchange rate goes from 12 to 13. What do I have to write off? What do I have to recognize as a gain or loss? All right. So that's what we're going to do. As this exchange rate goes from 12 to 13, is that a devaluation or appreciation of the peso? It's a devaluation of the peso. How you doing? So what we're going to try to figure out is, what does Zapata have to do? What do they have to recognize as a gain or loss? So that's what we're going to do. All right. So what I need to determine now is, what is the translation rule? What is the accounting translation rule that determines that if this exchange rate goes from 12 to 13, which of these counts have to be restated? Now, before I even talk about possible accounting rules that would cause you to have a gain or loss for Zapata, you can see there could be a lot of opinions. Like, why don't we just revalue cash, right? That's the only thing that's actually sitting in pesos, right? Make sure why do we have to revalue net fixed assets? Do I really have to show a gain or a loss on property, plant, and equipment every quarter? So forget about that. Don't worry about equity. So there's could be a varying, it could be different ways of trying to decide which accounts get revalued, which one get left at the old exchange rate. You okay with that so far? Here are 4 possible translation methods. Only 2 become relevant. All right, and all they relate to is which of these accounts have to be revalued based on the new current exchange rate. And if the exchange rate goes to 12 to 13, do I show a gain or a loss? So let's say the one method is the current rate method. Current rate method's easy. All right, it's brutal too. That means every asset, every liability gets updated to the current exchange rate every period. So every asset, every liability gets revalued at the new exchange rate of 13 to 1. So remember I said we do exposure netting? Well, if you do exposure netting, you take all assets minus all liabilities, right? And say I'm long 135,000 pesos. I'm a net receiver or an asset position of 135,000 pesos. So that's the net amount that's going to get the new exchange rate. So current rate means use the current rate for all accounts. Now here's a little bit of confusion on this next one, the current non-current method. All right. The current non-current method is something a little bit different. A current non-current method says simply revalue the current accounts. All right. Current accounts meaning, say, cash, receivables, payables, inventory. So cash, receivables, payables.
And everything that's expected to occur within 1 year?
Yes. Or, well, in accounting jargon, what are the current accounts? What are your current assets, current liabilities? But yeah, in practice, it's kind of what stuff is going to come in the next year. Yeah. But it's not simple. But for these purposes, it would be all accounts receivables. You wouldn't go with accounts receivables and which ones are expected to be paid later. All right, and this makes a lot of sense, right? Well, let's only look at the ones that are actually going to turn into pesos, and I'll take those pesos and turn into dollars this year. This makes a lot of sense. Let's only use the current assets and current liabilities. And if we do that, this firm is long 36,000 pesos. They're a net receivable of 36,000 pesos. So you can see the exposure is a lot different, right? Do I do an exchange rate of 12 to 13 change on this amount or 12 to 13 on this amount? So I like that method. Let's only use the stuff that's going to turn into cash. Make sense? Well, I kind of like this one too. The monetary, non-monetary method. This method says, all right, let's only use the accounts that represent cash. In other words, they don't represent a real asset. So, cash is cash. That's easy. We said this is really property, plant, and equipment. Right? So that's not going to count. However, accounts receivable is cash, right? It's not an asset. It's not a widget or something like that. So we're going to use this one as a monetary asset. This is a monetary asset. This is a monetary liability. This is a monetary liability. So all the things that simply represent monies, amounts of monies, which are receivables, payables, debt, and cash, those are the only ones we're going to have to revalue. Yeah?
Why would long-term debt be an issue? It's really, we're talking about rates that can change every day.
So this method is simply looking at only accounts that are simple claims to cash. They don't represent a real asset. They're simple amounts of monies. All right, so, but you can see, yeah, maybe we should exclude long-term, so maybe we should use current rate method or current non-current method. But yeah, you're right. What if this is a 30-year bond and it doesn't come due for 30 years? That's only the interest components we'll hit earlier. But that's the downside of this. All right, so you can either use the everything, revalue everything. You can only use the current assets, current liabilities, because those are the ones that are going to be turned into pesos and then back into dollars. You can use only the monetary ones. And then there's one more method, the temporal method, which is basically the monetary, non-monetary, but then just add inventory to it, because inventory is going to be sold off and turned into cash. So that's it. Those are the 4 likely translation or possible translation methods that could be used to determine which accounts keep the old exchange rate and don't have gains or losses, which one uses the new one. Yeah.
So, do you modify your balance sheet based on exchange and currency?
Yes. You wouldn't modify Zapata, you'd modify the US one.
So in accounting, there was something called a conservatism principle, where if you would write something down if you had a reason to do so, but you wouldn't write it up even if there was good reason. Why does that not apply for currency?
So you're talking about a principle in accounting that says what accounts do and do not. This is very specific. This takes precedence over that, because this is literally the accounting rule that determines what foreign currency accounts get revalued. Okay, so it's very specific. All right, so there's no once you determine which method you have to use, and I'll tell you how to do that. Then there's no what is conservative, what's not conservative. Marty.
Are there methodologies to track when you don't change the rate on everything, what you have written down, what you haven't written down, what is that the old rate, and what old rate it's at as opposed to what rate it's...
Right, so say that property, plant, and equipment was something you bought 20 years ago, recorded at 1 peso per dollar, right? And your question is it's updating every period. How do you keep track of that?
Yeah.
That's up to the accountants.
It's just a big mess.
That's in the ledger. You'd go in there and see what that $100 property, plant, and equipment purchased 30 years ago. What was the exchange rate used to book it? Yeah.
So that's this each company.
So good question. How do I determine this? Each company decides this for each subsidiary. So you may have a different rule for each subsidiary. Okay. But now I'm not talking about just Microsoft having accounts receivable in euros, right? That's obviously going to be gains or losses based on the actual exchange rate. What we're talking about is wholly owned, or partially or fully owned subsidiaries. How to treat those.
And then just looking at the other accounting methods, once they choose it, they need to use that.
Yes. But you could change it, but not too often. All right. So up until 1981, 1980 was good. Anyone remember 1981? That's a good year, right? It's a good year, right? So up until 1981, half of you weren't born, right?
More than half weren't born yet.
More than half weren't born yet?
More than half that weren't born yet.
That makes me feel old. I was driving around in South Jersey listening to Springsteen with a beer. All right, that's what days it was like. Fine. Wouldn't do that again. So, 1981. Up until 1981, it was the temporal method. So it's this method here. All monetary accounts and inventory get revalued. All property, plant, equipment, other stuff just stays. Okay? Simple rule. 1981 FASB 52, which is the one we're under right now, made it more complicated. It made it more complicated because firms have a choice. You can either choose the temporal method or you can use something else. So let's talk about that. So what you have to do now under the new guidelines is for every subsidiary, you need to determine what the functional currency of that subsidiary is. So if you have a Mexican subsidiary in Mexico City, it's probably the peso. And if you have a subsidiary in Germany, it's probably the euro. However, there are a couple cases. Maybe you have a subsidiary just over the border in Mexico, which is a production facility for your equipment, but it's pretty much just it's considered mostly a dollar-based business. That actually may wind up being the dollar as the functional currency. But other than those rare occasions, you're generally going to specify the foreign currency as the functional currency. Once you do that, once the foreign currency is the functional currency, say the euro for a German subsidiary or the peso for a Mexican subsidiary, you're going to use the current rate method. Revalue everything at the current exchange rate, even stuff that you bought 50 years ago. Revalue everything. So that saves Marty's problem that everything just gets revalued every period. You don't have to remember what you did. But when you revalue everything, just make an adjustment in your balance sheet. You don't actually have to flow it through earnings. So in other words, if you had a property, plant, and equipment in Mexico City, and the peso devalues from 12 to 13, you're going to have to write down the asset in your balance sheet. All right, now to get the balance sheet to balance, you're going to make a little adjustment to equity, but you'll never hit earnings. So it's the one of the situations that I know of that there's a disconnect, that you have a gain in the balance sheet, but it never hits earnings. That's generally what companies are doing, is they're choosing that the foreign sub has a functional currency as the foreign currency. They apply the current rate method, revalue everything, but there's no earnings impact because it stays in the balance sheet. Now, if they choose the dollar as the functional, then they use the temporal method, use your monetary assets, monetary liabilities, and inventory, and it does hit the income statement. So all companies have a choice for every sub. I can either have big gains and losses get stuck in the balance sheet, or smaller gains and losses hit earnings. That's the basic choice. And almost every situation I've seen, the foreign currency is the functional. Not everyone, but.
A big company like Microsoft would have two different
Yeah. So yeah, each subsidiary would have to choose. All right.
Can you explain again, like the company that provided services, a lot of call center are in, say, Bangalore, India, and then they have the foreign currency as a functional currency, and they sign a contract with the U.S. company to provide a service, right? So what happened to? So I'm assuming it's the bottom method using current rate method.
Is this a subsidiary, or is it just sales and receipts to a foreign current country? Subsidiary.
Like Cognizant, right? They have office here, headquarters in India.
No.
Or
Cognizant is located in the US.
okay.
And you're in
Well, anyway, so over there they provide like a call center to different U.S. companies with the Indian currency.
Well, call center would probably not be considered a subsidiary. That would just be, say, an outsourced labor. In that case, it's just gonna flow through accounts receivables and payables. So all that's gonna wind up hitting the income statement. So that's a case where it's not. I'm guessing it's not subsidiary, but I mean, I don't know. I'm not in accounting too heavily, but so we're not talking. I don't think we're talking about simply having a call center over there. We're talking about, say, a subsidiary that you own at least 50% of subsidiary. All right.
Yeah. So when the Indian currency devalues so much now, what is the impact to the mother company?
Okay, so if it's simply an outsourced labor, an outsourced call center, okay, let's just make an easy situation where you kind of lease some space in India and you pay some workers in the call center. All else, if that's the only situation, a devalued rupee is going to cause your cost to go down. Just when you have the payables and you pay them a fixed rupee salary, or have a contract with one of those companies over there that runs it for you, you're just going to have a reduction in your cost.
So it's actually a net benefit to your company.
Yes. Yeah, so if you're outsourcing labor anywhere and their currency is devaluing, it's getting cheaper in dollars to pay it. All right, now where it gets really confusing, not really confusing, but what we're going to talk about next week is depends on what's causing the devaluation of the rupee. What did we say was one of the main causes of a currency devaluation? Inflation. So you have to actually see what's causing the devaluation of the rupee, and that's going to be next week's lecture. Because what if inflation in India is 5%, and the rupee devalues by 5%? It's going to have no effect on your business, because you're going to have to wind up effectively giving raises to the employees by 5%, but it's going to be 5% cheaper to buy the rupee. So that's when we get into competitive exposure, is kind of long term, when the wage contracts get reset based on inflation levels. So that's a little more complicated. I want to push that till next week, if that's okay. Yeah.
Continuation of the same question.
Sorry, I didn't
No,
know.
no, no,
that.
No, that's okay. I mean, it's a similar question. So Cognizant is headquartered in the US, but there are subsidiaries in India and other European countries.
They're incorporated in the U.S.
Yeah, headquartered in the US. But there are other Indian MNCs like Satyam, Wipro, Infosys. They are headquartered in India, but they operate in the US also, and there are subsidiaries over there. So how will it differ for this kind of countries? But then again, Cognizant's 70 to 80% of workforce is based out of India, similar to the other companies which are headquartered in the US.
I guess we'd have to see how the subsidiary structure is set up. So maybe I'll take a look at that. If you can send me a link, I'll take a look at see how that's structured. I'd like to. Yeah.
Is FASB United States only, and then
Yes.
like with everything else, there's like the American, then there's everything else.
Yeah. So there's a European FASB standards. So this is U.S. based. Yeah. But this is what gets reported to Wall Street. Your earnings number, your financial statements are reported in dollars according to FASB. But if you want to issue equity overseas, you have to restate it based on European rules. Right. So, remember we said the exchange rate was 12 to 1 at the beginning of the year. 12 pesos per dollar. So, depending if the parent decides to make the dollar the functional or the peso the functional, that's going to determine whether they're exposed to a full revaluation of all assets and liabilities, or simply the monetary, non-monetary, and inventory. So, if they choose the dollar as the functional currency, we have to go back to this thing. If they choose the dollar as the functional currency, they're going to only revalue the temporal accounts, which means monetary and inventory. So I'll just take cash, receivables, inventory, payables, and long-term debt. So I'm only going to revalue those 5 accounts. Those 5 accounts have a net position of 24,000 pesos. Let me jump down to B. If 24,000 is your net position, and the exchange rate goes from 13 to 12. All right, goes from 13 to 12. All right, exchange rate goes from 13 to 12. And the question is, what is your dollar gain or loss? To convert this into a dollar, right, we need to have dollars over pesos. That's what we talked about last week. So the exchange rate, the new minus old exchange rate. So what I'm going to do is I can see the direct impact of that exchange rate change by taking my net position in foreign currency. I'll call that V. The net position in foreign currency times the new minus old exchange rate, or make sure they're dollar over FX. So if they choose the temporal method, meaning the dollars are functional, their net exposure is 24,000 pesos. The exchange rate goes from 12 to 13. They're going to show a $154 million loss that goes directly to the income statement. And that's going to hit their earnings per share if they use the temporal method.
Why would a publicly traded company choose to use the temporal method if it's going to affect their earnings?
Well, there's a worksheet to determine whether it's dollar or the foreign currencies. Almost always it's going to be the foreign currency as the temporal, but there are special cases, and usually these are businesses are just over the border in Canada or Mexico where you specify the dollar as the functional. So this is very rare that the dollar would be the functional. Right, so it's basically just having a production facility right over the border to get some kind of arbitrage and regulation or something else. Okay. So what you're saying is what's most likely going to happen is they're going to specify the peso as the functional, which means they have to revalue everything. So just take every asset minus every liability. Well, I could just go right to my equity position, right? Equity is assets minus liabilities. So they're going to have to revalue everything. That net position is 135,000 pesos. Take that new minus old exchange rate, 865 million. But it gets stuck in the balance sheet, never hits income statement, doesn't affect your earnings, doesn't affect your bonus. That's the choice companies have. So if you're working in your organization and you have a lot of business with in a foreign country, and you have a subsidiary set up, the first question, and you see the exchange rate changing, right? The Argentine exchange rate's plummeting, Venezuela. The first question you should be asking your people is, what's our functional currency? I need to know if this is going to hit my bottom line, how big. It's going to hit me no matter what, but I need to know, is the dollar, what's your functional currency? That's the number one thing you should ask for your subsidiaries. All right? Because you're either going to hit the income statement or the balance sheet. Generally, firms don't worry about the balance sheet, right? You never hear a lot of headlines that, Microsoft missed their balance or had a balance sheet restatement. No, it's all about earnings and missing Wall Street estimates by a penny. Even though this may be real someday, it's not hitting the income statement yet. Yeah.
So I can correct me that top example there in cases, that's like an Ecuador type operation. Right on the other side of the border, just
Yes, exactly. Yeah. And there's a name for the Canadian one too. Yeah. So, yes. So it'd be just having this little production facility over the border, or it could be a large one. But yeah. So you need to know what is your functional currency. If your functional currency winds up being the dollar, you may have some big problems to earnings. If it's the local currency, the peso, you may have problems, but they're not going to hit you as big and as fast.
So in the past, I don't think they allow this anymore, but in pharmaceutical, they usually move it into the inventory in transit into an interim warehouse, and then the price raised at the beginning of each year, and then they shipped it into the warehouse of the company with a higher I guess cost, and then it would show as a gain in their net income because it's accounting for inventory.
Yeah, I have to see that transaction. So you wonder if they're just kind of gaming the system by doing an internal transfer at a favorable exchange rate to try to show a gain. But I have to see the write-up on that. Yeah, that'd be interesting. All right, so this is what we're talking about, translation gains or losses. To determine translation gains or losses, you need to know the translation method. Translation method is determined by each subsidiary, and that's determined whether or not you specify the dollar or the foreign currency as the functional. All right? That's a long story to get to that one. All right? So, translation exposure. All right, let's talk about the IMM. I think I did this in my first year class. When I did risk management for a living, we talked about the IMM process. You identify what you're exposed to, you measure what the losses could be, and then you decide to mitigate it. So if we're talking about translation exposure, we needed to first identify, are we long or short what currencies by subsidiary? Then we're going to measure our exposure. It's going to look like this maybe. And then we're going to decide how to mitigate them. So let's talk about Zapata's translation exposure. What are they exposed to? Well, no matter what method, if we use the temporal or the temporal method or the current rate method, they are long the peso. So they are exposed to a devaluation of a peso. That's their exposure. All right. So first determine, what are you exposed to? I'm exposed to a devaluation of the peso, right? The exchange rate going from 12 to something above 12 because of the indirect exchange rate. Going up means it's devaluing. Bless you. All right. Next step, how much can we lose? All right, so we're long the peso, how much can we lose? The first thing to do is get your position. If the dollar's the functional, your position is your long 24,000 pesos. That's the net asset position that has to be revalued. All right. If US dollar is the functional, if the peso is the functional, it's 24,000. If the dollar is the functional, it's 135. So you need to determine which one it is. All right. So, however, if the peso is the functional, let's keep going with that. If the peso is the functional and you're long 24,000 pesos, we needed to figure out how much money can we lose. So we're waiting here before any rate change actually has happened. We're trying to figure out, well, how much could we lose? Well, the easiest thing to do is do a 10% stress test. Just take 24,000 pesos and have a 10% change the exchange rate. So a 10% devaluation of the peso would be the exchange rate going from 1/112 to 90% of that. So it's going from 1/12 to 1/13. All right, so look at the math I did on that one. And a 10% devaluation of the peso, right? The price of a peso today is this, right? 1/12. That's the price of a peso today. If that drops by 10%, I'll get that value, 1/0.0175. That means a 10% devaluation of the peso is the peso going from 12 to 13.33. If that happens, the exchange rate goes from 12 to 13.33, you could lose $200. All right, so many companies, the first thing they do is have plus or minus 10% stress tests. Based on our accounts and our translation method, we have a 10% adverse change in the exchange rate. We could lose 200, in this case millions, because everything was in millions. All right, that's one way to do it. 10% stress test. The other method is earnings at risk. We did at-risk measures in the first year, didn't we? Did we do that? Like 10-minute lecture on when I did the risk measures. So here's the second, well, probably the more common way of trying to figure out what your losses are. Take your value of your position, 24,000 pesos, and multiply, and we're going to calculate a 95% confidence interval, 1 year earnings at risk. Compute the annualized standard deviation of the peso. And I estimated it's roughly about a penny per year. Okay? Penny per year. In other words, 1/112 is the current exchange rate, which is, 7.5 cents. The 1 year standard deviation of the peso is about a penny. Using the normal distribution tables, I can find a critical Z value for a 95% confidence interval. What this tells me, if I take 1.65 times the standard deviation, if we assume changes in the exchange rate are normally distributed, that means that change has a 5% chance of happening. A 1.65 standard deviation change in a variable has a 5% chance of happening. So, if I take 1.65 times 0.01, all right, that's 0.0165 pennies, all right? Times 24,000, that's 396, that's $1 million. That will be a standard reported exposure for this company, most likely. And what that 396 means is, based on our position of 24,000 pesos and a standard deviation of 1 penny per year, I'm going to use a normal distribution figure of 1.65, and that'll tell me that I have a 5% chance of losing $396 million or more. Yeah?
Simple question, sorry. Using alpha 0.05, is it pretty standard in the industry, or?
So great question. So my basic formula here is V, my position in pesos, my standard deviation, and my Z. Now I said Z use 1.65 if you're using a 95% confidence interval. The only other number that I've ever seen used is 2.33. And that's for a 99% confidence interval VAR, or earnings at risk. So in other words, if I replace this with 2.33, I would then call that a 99% confidence interval bar. That number's going to be bigger, and I'd say there's a 1% chance of losing that amount or more. All right, thanks for asking. All right. So this actually talks about that here, that my risk is my value in foreign position, in the foreign currency, my standard deviation, and it's got to be in direct terms, and then my Z is either 165 or 233, depending if your company reports 1% losses or 5% losses. So if someone tells you your 95% EAR is 396 million, what they're talking about is the distribution of possible losses. That there's a 5% chance of having a loss of 396 or more, but your 95% confident losses will not exceed 396. Whether you report a 1% or 1% or 5% doesn't really matter. Just make sure you know what everyone's reporting and make sure everyone's consistent. All right, so IMM process. What are we exposed to? We're long the peso. What's our position? Well, based on our currency, functional currency, we're long 24,000 pesos. Our stress test is we could lose $200 million. Our earnings at risk is we could lose 396. All right, so this is the IMM process. What is your exposure? How much can you lose? Next step is, what are you going to do about it? All right, any questions so far? All right, so this is a standard process for any risk you ever have in your company. What are you exposed to? How much can you lose? What do you do about it? All right, so we've gotten that far. What can you do about it? Well, one thing you can do is do nothing. Accept the risk because it's either immaterial. Yeah, it's an Argentine subsidiary, but it's like 1% of total revenues. Who cares, right? Or it's unhedgeable. Right now, there's nothing we can do about it. Contracts are all set. It's too late to get any hedging in place, so we're not going to do anything. Or sometimes it's too costly. Well, I could have bought an option, but with that whole world, South America blowing up right now, the options are so expensive, no one's going to give me a good price, so it's too costly. Or you just say, you know what, I don't care. We're all over the globe. We're macro diversified. I don't need to hedge every foreign currency. Some are up, some are down. Who cares? So those are all reasons to just accept the risk, do nothing. But not that you don't care. Let's say the question is, why don't you care? If you don't care because it's immaterial, that's okay, right? That's like, it doesn't have a big effect on our earnings. So that's easy. Or it's just there's nothing you can do. Or the costs are so prohibitive, it doesn't make sense to do it. Or, we're in 100. We have 100 different currencies. Some are up, some are down. This one isn't that particularly big, so we won't worry about it. So you could just say, I'm not going to do anything. I'll just accept the risk. That's the risk of doing business. All right. The other thing also implied to this is you're very profitable. Right? Companies that are very profitable tend not to hedge as much. It's like enough buffer, right? If you're making 30, 40% margins, you don't care if an exchange rate goes 5%. Right? Why do it? It kind of gets to immaterial.
Is that what you're talking about in the class yesterday about financial theory, that if everyone is diversified, if you lose here, you'll make it?
Yeah, so I didn't even mention this word. Or you might just say, the shareholders are diversified. I shouldn't be hedging FX risk because my shareholders are fully diversified across the globe, so they shouldn't care about the exchange rate. Yeah, so that's a good point. This is the discussion we had yesterday. Is not that we're just macro diversified across the company, but my shareholders are diversified across the globe. So those are all reasons to do nothing. But most companies don't do anything. Number one reason, they care about themselves. They care about missing earnings, not getting their bonus, or their company having troubles, and they're going to lose their job. So most of them are going to do some mitigation. What mitigation can they do? one thing, designate the foreign currency as the functional, this whole problem goes away. It just gets pushed to the balance sheet, and it may show up another day as a transaction gain or loss. You could do exposure netting. So here's an important one. One way of getting rid of a lot of a translation exposure is by, when you first set up the organization and fund it, you can eliminate a lot of your exposure right away by simply getting loans in the foreign currency. So if you're going to set up a Mexican subsidiary in Mexico City, the first thing you want to do is borrow pesos to build it. Don't borrow dollars. Because you're going to be generating revenues and profits in pesos. A natural hedge that will last for the term of the loan is by just having interest payments in pesos. So it makes perfect sense to finance any foreign venture that's going to generate currencies in that area. A natural hedge is to simply finance it using foreign currency. Don't get a dollar loan.
Is it going to be applicable to what type of currencies? Like, let's say you're assuming here that the peso will be devalued in the future.
Well, this is not taking a view on it. This is just saying, I don't know what's going to happen to the currency, but if it appreciates, that loan looks worse, but my revenues are looking better too. So it's just becoming a natural hedge, right? You're going to have revenues and some expenses in pesos. Why not have another expense that's also in pesos? So you don't work. It's just natural hedging. Right. So there's a takeaway for the day. Make sure you're financing your foreign ventures with foreign currencies, not in dollar loans, because then you're winding up with dollar interest payments. And when that foreign currency devalues, you may not be able to cover them. To the extent you can, try to avoid having receivables in currencies that are about to devalue. All right, so you know you're doing business in Argentina, and you know there could be contagion in South America right now. Try to start liquidating all those accounts now, especially the cash. So any company that currently has cash in South America, start converting it to dollar now. Just get out of those currencies which may fail. Weak currencies is just a kind of a name in finance for currencies that are more likely to devalue. Hard currencies are ones that are expected to keep their value. All right, so that's what I would be doing if I had South American subsidiaries right now. I'd be moving any foreign currencies that are sitting there in cash, moving them to dollars now. I'd be trying to pressure receivables to get paid right away, keeping the liabilities out there as long as possible. Yeah.
Is there an example of an untangible situation that's not like internal to the company, like the company can't afford to do it, but something more external? Is that like an embargo situation where maybe you can't?
There's a couple of situations. One is a technical one in that some currencies are untradeable outside of their home country. So it becomes very difficult to get forwards and options in that currency. Although Wall Street's largely gotten over that by creating derivatives that pay you. So don't worry about that. The biggest one is just unhedgeable costs. For example, one exposure, kind of the classic example of this is the U.S. automakers have a severe exposure to a devaluation or an appreciation of the yen. If the yen, devaluation of the yen. If the yen devalues, the Chinese automakers will be able to sell cars to Americans at a cheaper price. One thing they could do is hedge their foreign exposure by buying forwards and options on the yen, but it would be such a large exposure they decide that's the risk we're going to accept. So sometimes they're just too big. However, simple receivables, payables, that usually doesn't happen. You just hedge these things in foreign currencies. So, I'd say there's a few examples of that. You could then get forward contracts to lock into all these things. Here's the problem, though. Say you took my class, so you go to your manager of the Argentine subsidiary tomorrow and you say, hey, let's go hedge those Argentine pesos today. It's too late. Why? Because the forward contracts already are going to be reflecting what's expected to happen. Well, if they're not, I would hedge. So the only time to really hedge is before the problem occurs. So as you're putting those receivables in Argentine pesos on 2 years ago, you should have been hedging them then, not when that part of the world starts to blow up. Because the forward prices already reflect of a continual decline in the peso. So I say you use forward contracts, but you got to do it before the problems arise, not after, because then it's too late. And then you can also use options and swaps. We'll talk about that a little bit later.
So for number 3, just real quick, increasing the hard currency assets, that makes sense. Increase the cash in something like dollars that you're expecting, like it's more consistent. Increase the soft currency liability.
Yeah, so if I had an Argentine peso payable, I would just not pay it for a while. I'd keep it out there because the peso is devaluing every day. So it's just keeping that out there. And if I had a loan out there in pesos, I would not be paying that early. I'd be stretching it out as far as possible. You know, making the minimum interest payments. Yeah. All right. So this is translation exposure. The number one thing to do, designate the foreign currency as the functional, all your problems go away. As far as translation, not transaction. All right, let's talk about transaction exposure. Transaction exposure are real gains or losses, right? When the receivables and payables and inventories turn into foreign currencies and you trade those back into dollars, you have real gains or losses. So that's what we're going to talk about, translation gains or losses. So say Zapata, they estimate, say in the next year, they're going to have receivables, inventories, and payables are all going to be liquidated. All right, so now we're not talking about translation methods. It's really just estimating what's coming due. Kind of a question came up earlier. What's coming due this year, people? All right, I think the receivables are going to come due. We're going to pay off the payables and sell off our inventory. So net, we're going to receive 35,000 pesos this year. All right, so what are we exposed to? We're long the peso. How much? We're going to receive 35,000 pesos. Receive. This is not paper gains and losses. We're going to wind up selling 35,000 pesos and receiving dollars this year. So we're going to wind up being long 35,000 pesos. The exchange rate changes 10%. We could lose $291 million. If I take that 35,000 pesos times the 1.65 standard deviations, there's a 5% chance we lose $577 million or more. All right, so all I'm doing in this slide is I'm changing. This used to be 24,000, but now we're not looking at translation accounts. We're just looking at accounts that are expected to come due. How many pesos were expected to receive this year? That's the only difference: translation versus transaction. However, these numbers are straight to the income statement. Right? There's no choice of burying them in the balance sheet. They're on straight to the income statement. All right, that's the only difference in translation versus transaction. Transaction are real, translation are paper and gain. When determining translation gains or losses, you have to ask an accountant, hey, what's the rule? What accounts get revalued? Transaction, you simply estimate which accounts are actually going to turn into pesos this year. What do? Well, you do a lot of the same things. Exposure netting, try to get liabilities in pesos if you have receivables in pesos. Increase your hard currency assets, decrease, what's one of these should be? Increase your hard currency assets and increase your soft currency liabilities. Now, you can also, when we talk about invoices, you could have price adjustment clauses. All right, so this is a very common thing. If you have South American subsidiaries and they want to be billed in their local currency, right? It seems like a respectable thing to do. And you'll say, that's fine, but you'll have a little clause. As long as the exchange rate is between this value and this value, we'll pay you in pesos. Or we'll accept pesos. That's fine. But if it goes out of that, here's a little schedule that adjusts the actual price in pesos based on the exchange rate. So it's kind of like a little risk-sharing clause that, well, as long as the exchange rate's close, that's the amount in pesos. But if it's not, we're going to adjust things. Yeah. Peter, you got a question? No. Okay. All right. Or you can enter into a forward contract to hedge the net position. So if I know I'm going to be the net receiver of 35,000 pesos 1 year from now, I'm going to enter into a forward contract to sell 35,000 pesos at an agreed upon price of the bank, and I don't worry about what happens to the exchange rate. I'm locked in. Technical note on the EAR. Again, take your value or position times the standard deviation times Z. Z is going to be either 165 or 233, depending if you're using a 95% confidence interval or 99% confidence interval. The other thing you could do is scale the EAR. What if your exposure isn't a year, but it's half a year or 1 month? You could scale the EAR by taking this number here. So your VZ sigma, what you can do, your VZ sigma, you can scale standard deviations across time. So what if the account is due tomorrow? It's not due a year from now, due a year from now. You can take the standard deviation, annualized standard deviation, and divide by the square root of roughly 260 business days in a year. That would be the daily standard deviation. So generally what I get in finance is I always have annualized standard deviations, or sometimes daily. But if I had to convert them, what I'll do is I'll scale them across time by either dividing or multiplying times the square root of time. In other words, if I had an annual standard deviation, I could divide by the square root of 260 business days in a year, and I get a daily standard deviation. That'll then give me a daily EAR. But if I had someone gave me a daily standard deviation, I can multiply it times the square root of 252 and get an annualized EAR. So you scale standard deviations with the square root of time and not time. A technical note. I'm sorry, 260 is 252 is actually usually the number of days the New York Stock Exchange is open. So I use that one for investment problems. So 260 is usually business days. Sorry about that. All right. Also, one other small technical issue is often standard deviations aren't given to you like this, 0.01 penny per peso. They're not generally given to you like that. A lot of times, what they're given to you as percentage standard deviations, as percentage standard deviation. So they'll say the percentage annualized standard deviation is 10%. If they give you that, just multiply times the exchange rate, and that'll turn it into the foreign currency. So example, the standard deviation of the euro is 10%. The exchange rate's $1.10. That means the standard deviation in dollars is 0.11. So just a technical note if you see these come up. All right. We'll talk about this next topic. So this is it. We talked about when you see a headline that your company is losing money due to foreign exchange exposure, you need to read very, very precisely. Look for the words translation or transaction, or sometimes balance sheet or income statement. You need to find out whether they're talking about just a writing down of assets and liabilities due to the exchange rate, or there's actual cash flow gains or losses. All right. Some translation gains or losses can make their way to the income statement. So you need to ask your managers, your accounting weenies there, what are my functional currencies for our subsidiaries? Which ones aren't the foreign currency? Because those are the ones I'm worried about. All right. The translation method determines which accounts get revalued. However, for transaction exposure, it's just what's expected to come due and what was the exchange rate on the day we turned it back into dollars. Any questions? So I'd recommend over the next 10 minutes to have, say, a minimum of 3 coffees. A minimum, all right? Because what we're going to talk about is some of the harder material in finance you're going to have in the program for this 1 hour. And that is very technically, the first part of the lecture is nice and easy, just how to use forward contracts to hedge all these positions. So I'll just tell you, if you had to do it, what would you do? If I actually needed to hedge 100 million euros, I'm going to tell you step by step what to do. Go Google what the forward exchange rates are from several different sources, call your local bank, use that, get the best rate, lock it in, and you're done. But then I want to talk about options. What does it mean to buy an option to sell my euros at $1.15? And what should that cost me? And what does that do to my exposure? All right. So we're going to talk about that for the last 30 minutes of that lecture. All right. So that's going to be a lot of fun. So I got 1047.
Use the Excel and start file and then file.
No, we're just going to double click in the file and play with it. And actually, it's embedded. So what's the 1102? 1102?